Imagine this. You've meticulously planned for retirement. Your investments are humming along, maybe travel plans are starting to take shape. You feel ready. But then there's this massive, often overlooked expense kind of lurking in the shadows, an unpredictable cost that could derail everything. We're talking about long-term care. Today, we're doing a deep dive into long-term care insurance, LTCI, because, well, Americans are living longer, right? And that means the likelihood of needing some kind of extended care is just going up and up. It's a real planning challenge, honestly. It could devastate even really well-prepared retirement plans.
Absolutely. And our mission today, really digging into the source material you've got, is to cut through some of that complexity surrounding LTCI. We want to pull out the crucial insights, not just what it is, but why it's such a vital piece of your financial puzzle. The goal is simple. For you to walk away from this deep dive feeling well-informed, ready to tackle this important decision.
Okay, let's unpack this because, yeah, this isn't just about numbers on a spreadsheet. It's really about peace of mind, isn't it? So let's start basic. What exactly is long-term care?
Well, it's a pretty broad category of services, right, for people who can't manage basic activities of daily living on their own anymore, ADLs. We're talking about fundamental things like bathing, dressing, eating, continence, just getting in and out of a bed or a chair. But here's something maybe folks overlook, and the sources really stress this. It also covers cognitive impairments, so things like Alzheimer's, other kinds of dementia. Even if someone's physically able, they might still need long-term care services.
That's a really key point. And these services, they can be delivered in a surprising number of places. You could get care right in your own home. That's what most people prefer, naturally. Or adult daycare centers, assisted living facilities, and of course, nursing homes.
What's critical to understand, and our sources really hammer this home, is that the level of care and where you get it drastically impacts the cost. Nursing homes, yeah, typically the most expensive. Lots of skilled care involved, but don't underestimate home care. It can get just as pricey, especially if you need, round-the-clock help. It's fascinating how widespread this potential need is. It's something a lot of people still kind of underestimate when they're planning for retirement.
Yeah.
This isn't some niche concern. It's a pretty significant likelihood for, well, almost all of us.
And the stats really back that up. Looking through the data, it consistently shows something like 70% of Americans over 65 will need some form of long-term care. The average time is about 3 years. But, and this is the tough part, it could be much shorter or way, way longer. And there's a demographic piece too, right? Women often need care longer.
It's often due to longer life expectancy, and they're more likely to be living alone later in life.
So, okay, with those kinds of odds, the obvious question is, can't we just rely on, Medicare or Medicaid? Our deep dive suggests for most folks who've planned well for retirement, relying only on those isn't really a workable strategy, and there are clear reasons why.
Right. First off, Medicare. It provides very limited long-term care coverage. It's mainly for short-term skilled nursing care after you've been in the hospital. It just wasn't designed for that ongoing day-to-day custodial care.
Okay. And Medicaid?
Well, Medicaid does cover long-term care costs, but there's a huge catch. It only kicks in after you've spent down almost all your assets. You have to meet really low asset thresholds. It basically means you and potentially your spouse have to become impoverished first.
Wow.
Yeah. It's really a safety net of last resort, not something you'd build a comfortable retirement plan around.
So the reality check is you can't just assume those public programs will cover long-term care needs. And when you actually look at the costs involved, it becomes painfully obvious why you need a Plan B. The sources give 2024 national averages, and honestly, they're eye-watering. Nursing home, over $108,000 a year.
$108,000.
Assisted living is around $60,000. And even getting a full-time home health aide that can top $70,000 annually.
And here's the real kicker. Those numbers aren't standing still, they're climbing. Typically 3 to 5% every single year.
Oof.
So that $108,000 nursing home cost today, think about what that looks like in 20 years. It's a huge financial risk, especially for a couple. If one or both spouses need care, it can just decimate savings, threaten the financial security of the healthy spouse. It's the kind of thing that keeps financial planners awake at night, frankly.
Right. Which really underscores why understanding the options to protect yourself is so important. So let's kind of navigate the actual insurance landscape. What are the main types of long-term care insurance out there?
The sources seem to break it down into 3 main buckets. First up is what they call traditional long-term care insurance.
Right. These are standalone policies. They're designed specifically for long-term care expenses, nothing else. Key features are the daily or monthly benefit amount, how much it pays out. Then there's the benefit period, how long it pays for, maybe 2 years, 5 years, sometimes even lifetime coverage. And the elimination period. Think of that like your deductible. It's the waiting time, usually 30, 60, 90 days before the benefits actually start paying out.
Okay.
Now, premiums are generally level when you first buy the policy. But, and this is a really important point from the sources, they can go up later. Not just for you, but for entire groups or classes of policyholders if the insurance company's claims experience is worse than they expected. Ah, okay. That potential for premiums going up, that leads straight to something the experts seem to really emphasize: inflation protection. Why is that so critical?
Oh, it's absolutely crucial. Think about it. The benefit amount you buy today, let's say it's $200 a day. That might sound okay now, but fast forward 20 or 30 years, will $200 a day even come close to covering care costs then, with costs rising 3–5% a year? Probably not.
Right. It'll buy a lot less care.
Exactly. So inflation protection is designed to make sure your benefits grow over time. Often it's like a 3% or 5% compound increase each year. It helps your coverage keep pace with those rising costs. Honestly, it's not just a nice to have. For long-term effectiveness, it's pretty much a must-have. Your future self will definitely thank you.
Okay, that makes total sense. What's the next type then? The sources mention hybrid life insurance with LTCI riders. Sounds interesting.
Yeah, these are pretty clever, actually. They combine permanent life insurance with long-term care benefits, kind of like a multi-tool.
Huh. How does that work?
Well, if you end up never needing long-term care, your beneficiaries get a death benefit, just like regular life insurance.
Okay.
But if you do need care, the policy lets you access a portion, or sometimes even more than, the death benefit amount to pay for your long-term care expenses. Often tax-free.
So you get value either way.
Precisely. It tackles that use it or lose it concern some people have with traditional LTCI. If you don't use the care benefit, your heirs still get the death benefit. Now, the trade-off generally is that these hybrid policies require bigger upfront premiums compared to traditional LTCI purchased at the same age.
Right.
But they usually offer more certainty about the premium staying level because it's backed by the life insurance component.
Gotcha.
Yeah.
And the third category, hybrid annuities with LTCI benefits.
Right. Similar concept, but using an annuity instead of life insurance. Think of a deferred annuity as primarily a savings vehicle that grows tax-deferred, often meant to provide retirement income later. The hybrid part here means it has a built-in feature or rider for long-term care. So if you need care, you can access your annuity funds, often an enhanced amount, specifically for those LTC costs. It gives you another way to tap into those funds, beyond just taking income withdrawals. Offers flexibility.
So it seems like there's no single best answer. It's about trade-offs.
Exactly. These different types offer real flexibility, but they each come with different pros and cons regarding, cost, how certain the premiums are, how you get the money out. It's really about finding the policy type that fits best with your overall financial picture, your goals, your risk tolerance, not a one-size-fits-all thing at all.
That makes perfect sense. Okay, so we've covered the need, the cost, the types of solutions. The next big question is when. When's the best time to actually start looking into this?
Yeah, timing is huge, and the sources are pretty consistent on this. Your age when you apply significantly impacts whether you can get coverage and how much it costs. Most experts generally recommend looking into it sometime in your 50s or maybe early 60s.
Why then specifically?
Well, typically your health is still relatively good in that window. That means you're more likely to qualify medically for the insurance. And crucially, the premiums would be considerably lower than if you wait until your late 60s or 70s.
So what happens if you wait? What are the real downsides beyond just paying more, based on what sources say?
That's a really important question. It's not just about higher premiums, although that's definitely part of it. The bigger risk of waiting too long is developing a health condition. Something that could make you completely uninsurable.
Like what kind of conditions?
Oh, things like a cancer diagnosis, Parkinson's disease, maybe multiple sclerosis, significant cognitive decline.
Yeah.
Even uncontrolled diabetes or severe heart issues can make it really difficult, if not impossible, to get coverage.
Wow. Okay, so the door can actually close.
It absolutely can. On the flip side, though, buying too early, say in your 40s, well, you'd be paying premiums for a very long time before you'd likely ever need the benefits. So finding that sweet spot, it really depends on your individual situation, your current health, very importantly, your family health history.
Ah, Family history matters.
Oh, definitely. If you have a strong family history of, say, Alzheimer's or other conditions requiring long-term care, that might push you to consider it earlier. And of course, your financial situation and just your personal comfort level with risk play a big role too.
It really is a delicate balance then, kind of like buying snow tires, You don't want to wait until you're sliding off the road in a blizzard.
Right.
But you also maybe don't want to buy them 5 years before you move somewhere snowy.
It's a pretty good analogy, actually. Timing it right is key.
Okay, so let's say you're in that window, you're looking at policies. What are the crucial features you absolutely need to examine? Our deep dive highlighted several key things. First off, the benefit amount and ancient pill. Period. Policies offer that daily or monthly payout, right? Anywhere from maybe $100 a day up to $500 or even more. And the duration, the benefit period, that could be 2 years, 3, 5. Maybe even lifetime coverage, although that's rarer and much more expensive now. And choosing the right amount there, it really depends on where you live. Care costs vary hugely by location. You need to look at average costs in your area, think about what other resources you might have, savings, income, and also consider any family support you might realistically expect.
Then there's the elimination period. We mentioned that's like the deductible, the waiting time before benefits start. It can range from 0 days, immediate coverage, basically up to, say, 180 or even 365 days.
Right. And the choice here really impacts your premium. A longer elimination period, like 90 days or 180 days, means lower premiums.
Yep.
But it means you have to cover all the costs yourself during that waiting period. So you need to have enough savings set aside to handle potentially 3 or 6 months of expensive care costs out of pocket.
So it's a trade-off between lower premium now versus potentially higher out-of-pocket costs later?
Exactly. Many experts often suggest a 90-day elimination period offers a reasonable balance for a lot of people. But again, it's personal.
Okay. And we already talked about it, but worth hitting again. Inflation protection. Non-negotiable, really, especially if you're buying coverage in your 50s or 60s. You need those benefits to grow. If you buy a policy today, think about its purchasing power 20, 30 years from now. Inflation protection is the only way to make sure your coverage actually keeps pace with those relentlessly rising costs.
Got it. Absolutely critical. And the last key feature mentioned was care settings covered.
Yeah.
You want a policy that's comprehensive, right? Covers care in different places.
Ideally, yes. Most modern comprehensive policies will cover care in your home, adult daycare, assisted living, and nursing homes. But you need to read the fine print. Some older policies, or maybe less comprehensive ones, might have restrictions. Like, they might require you to be in a nursing home for a certain period before they'll cover care back at home or in assisted living.
That sounds really restrictive.
It can be, especially since most people say they strongly prefer to receive care at home if possible. So you want flexibility in where you can receive care.
Okay, so that covers the main insurance options and what to look for. But what if traditional insurance isn't the right fit, or maybe isn't even possible? Are there alternatives?
Yes, the sources definitely highlight alternatives, each with its own significant pros and cons. One approach is self-insurance, basically deciding to cover potential costs yourself out of your own assets.
So just saving up a huge pile of money.
Essentially, yes. We're talking potentially hundreds of thousands, maybe even close to $1 million earmarked specifically for long-term care. The advantage is total flexibility. You control the money, and if you never need care, the funds just stay part of your estate.
But the downside?
The downside is you need substantial wealth to make it feasible, and incredible discipline not to touch those funds for other things over potentially decades. Plus, you bear all the risk if your care costs exceed what you saved.
Right. That's a big if. Definitely not an option for everyone. What else?
Well, on the other end of the spectrum, there's Medicaid planning.
We touched on Medicaid earlier, the spend-down requirement. So how does planning fit in?
Medicaid planning involves using specific legal strategies, often involving trusts or strategic asset transfers, done well in advance of needing care. The goal is to reposition assets so that an individual can eventually qualify for Medicaid to pay for long-term care, while legally protecting some assets, perhaps for a healthy spouse or heirs.
That sounds complicated.
It is extremely complex, and it's fraught with potential legal and ethical pitfalls if not done correctly years in advance with expert legal guidance specialized in elder law. It's definitely not a DIY project, and it's generally more of a later life or crisis strategy, not necessarily proactive planning in your 50s.
Okay, good to know. Any other alternatives?
Yes, for some, veterans' benefits can be a significant help. Eligible veterans and their surviving spouses might qualify for programs like aid and attendance, which provides a monthly pension supplement that can be used to help pay for long-term care costs.
Is that widely available?
Eligibility depends on factors like service record, disability level, income, and assets. So not everyone qualifies, and the benefit amount, while helpful, may not cover the full cost of care. It's definitely something eligible veterans should explore, though.
Listening to all this, what really strikes me from the source material is how interconnected everything is. It's not just about picking an LTCI policy in isolation.
That's such a crucial insight. You absolutely have to see this as part of your holistic retirement plan, not just a separate insurance decision.
How so? What are the connections?
Well, think about the premiums. How will paying potentially thousands of dollars a year for LTCI premiums affect your retirement cash flow, your ability to save elsewhere? Or consider taxes. Are the premiums tax deductible for you? Are the benefits received tax-free? Usually yes for qualified plans, but it depends. And how does needing care or having insurance to pay for it impact other decisions? Like, when should you claim Social Security? How should you draw down your retirement accounts? There are even strategies like using funds from a health savings account, an HSA, to pay LTCI premiums tax-free in retirement. That's a powerful synergy if you qualify.
So it really ripples through the whole financial plan.
It really does. It's about coordinating everything, your savings, your income sources, your other insurance, your estate plan, with your long-term care strategy.
Wow. Okay, this definitely sounds like an area where it's easy to make mistakes. What are some of the common pitfalls people run into, according to the sources?
Yeah, unfortunately, there are several common ones. Probably the biggest, as we mentioned, is just delaying the decision too long, waiting until your health changes and options narrow or disappear.
Right. The door closes.
Exactly. Another big one is buying inadequate coverage, maybe getting a policy with too low a daily benefit, or crucially, skipping that inflation protection. The policy ends up not covering nearly enough when care is actually needed decades later.
Or maybe it doesn't cover the type of care you want, like home care.
Precisely. Not checking the care settings covered is another pitfall. Focusing only on the premium cost is also a mistake. People try to get the cheapest policy possible, but they ignore the potentially catastrophic financial devastation that uninsured or underinsured care could cause. It's penny-wise and pound-foolish, potentially.
And there's a softer side, too, right? Not having the family conversations.
Absolutely. Avoiding those tough talks about preferences for care, who would provide it, how it would be paid for, that often leads to stressful, crisis-driven decisions down the road, which is the last thing you want.
So how do you avoid these mistakes?
Well, the sources consistently point towards getting professional guidance, working with a financial advisor or insurance specialist who really understands the nuances of LTCI and how it fits into overall retirement planning. They can help navigate the options, tailor a plan, and facilitate those important family discussions.
And the market itself has changed a lot, hasn't it?
Oh, dramatically. Our deep dive showed that many traditional insurance companies have actually stopped selling new LTCI policies because it turned out to be riskier than they initially calculated. We've also seen significant premium increases on many older existing policies, which has caused a lot of understandable frustration.
Yeah, I bet.
At the same time, these hybrid products, the Life LTC and Annuity LTC combinations, have become much more prominent. So in a market that's constantly shifting like this, how do you make sure you're making a smart choice?
Good question.
Again, it points back to leveraging expert knowledge, working with someone who understands the current landscape, the different product types, the stability of the insurers. It's not something you want to navigate just based on, website comparison.
That makes sense. And one more thing, the sources mentioned these partnership programs. What are those about?
Right. Partnership programs are collaborations between certain states and specific insurance companies. If you buy a qualified partnership LTCI policy in one of these states, you get an added benefit, extra asset protection if you ever exhaust your policy benefits and need to apply for Medicaid later on. Basically, for every dollar your partnership policy pays out in benefits, you get to keep an extra dollar of assets above the usual low Medicaid limits.
Oh, interesting. So it provides an extra layer of protection for your savings.
Exactly. It's an incentive to plan ahead with private insurance, offering a bit more peace of mind about not losing absolutely everything if you need very long-term care. Definitely worth checking if your state has one.
Okay, so bringing this all together then, what's the main takeaway?
I think the core message is that planning for long-term care is really a critical piece of comprehensive retirement preparation. It's not optional anymore for most people, given the costs and probabilities. And while, yes, the cost of insurance coverage can feel substantial, it almost always pales in comparison to the potential financial ruin of paying for extended care entirely out of pocket. The key is understanding your options, making decisions at the right time for you, and really integrating this planning into your broader retirement strategy.